I've mentioned before that a "that's different" look to the chart can set you up for some great trading opportunities. In a nutshell, a move that's different from the action that came before it is a clue that, for whatever reason, renewed interest in the instrument you're looking at has occurred. Now, this can set you up with a trend move or a mean reversion trade. Regardless of which it is, looking for moves that are different, it's not a bad way to get set to make a trade. Now, one area people look for moves is around support and resistance. I've mentioned support and resistance before, but for me, I look for obvious areas, as hidden areas don't really attract the masses. You can also expand your thinking to include ranges that have prices moving back and forth between the support and resistance extremes. The question that you should always be asking is, will these support and resistance zone hold price, or will they fail and either keep moving, or will they simply expand the range? There's a rather simple way to be clued into the probable hold or fail, and that is the rejection, or lack thereof, at the extremes. Now, what would you expect to happen to price if a support or resistance zone was going to hold? I would expect price to move away soon after testing the zone. On a side note here, soon is relative to the time frame that you're looking at. Now, this chart is a daily chart of an instrument, and we've been in an uptrend on this time frame for about 2 months. We have been in a range where the support and resistance zones have been identified. The higher time frame is also in an uptrend. Number 1 shows a sound rejection of the lows of the range. While the recent past has shown tests of the lows, this test leaves no mistake that buyers stepped in quite strongly at this point. And I find these types of rejections to be a "that's different" than I've seen in the previous price action. At number 2, we did see an expansion of the range marked with the green arrow, and while it's not perfectly visible, the candle label 2 has a closing price at the same level as the previous resistance zone. Even more telling, even though there was an expansion, the candle was certainly in line with the other green candles, and the solid red candle solidly ended that bull's run at that point. Now, this chart is a lower time frame of the same area, and a day before the strong rejection of price from the support zone. The horizontal line indicates the area that was acting as support, and you can see with the aid of the black line how forcefully price pulls away from that area. You can see at A test of the support zone, price pulls away. At B, price breaks lower, it's turned away. And C, one more test, and as indicated by the line, price sharply turns. Now, remember the green candle that expanded the range? Here's an inside look of that day. FR is the former resistance, and as price breaks that, A, price sharply turns from the new high, and B, indicates the retest and sharp rejection at the new high. Not shown on this chart, but price ranges with little interest the rest of the day, and it rapidly dropped the following day, printing a beautiful momentum candle. So do you think the strong momentum to the downside enticed those that trade breakouts? Price expands the range and then drops the following day to the bottom of the range with an obvious momentum candle. Breakout traders would read that as bear strength and are waiting for price to slam out the bottom of the range. And as we saw in the first chart, they were disappointed as price does break the zone but strongly rejects at lower prices, trapping shorts and forcing them to exit. That helps propel price back to the resistance zone of the range. So what happens when price returns to the resistance area? Looking back at the first chart and the number 2 candle, we see price break to new high, reject, but holds at the close of the previous candle in what many people would call a doji candle. So taking a micro view of that daily doji, A, breaks back below the previous close to the previous resistance zone and is soundly rejected. B, after making a high, price pulls back to the previous close and, as shown by the black line, chops around on top of resistance. Can there be any doubt that price will rocket the next day? Yeah, there could be a lot of doubt, but in trading, we think in probabilities. The price action highlighted by the black line shows that rejections of levels usually results in price moving away soon after arrival. When the probabilities of the test being successful increases, we generally see price consolidating at the extreme. The last chart showed something even better, and that was the sharp rejection away from the longer held resistance zone when price dipped back inside. We also never saw price move too far away from the support zone when that zone broke, and that should be a heads up as well. The trading chart tells a story, and unfolding price action around key areas of the chart can alert you to the probability of one thing happening over another. As hundreds of hours in front of the charts pass by you, you will see the weak and the strong play out, and will begin to hopefully be able to plan trades off the probability of X over Y happening. So start today by marking off obvious areas of support and resistance, and then drill down to the price action around those levels. Because experience, it's always the best teacher.